Well, it was a bit of a disappointing start to this holiday shortened week. We did see all four major U.S. indices in the red here today, although not dramatically so. We did see a company like Nike affect both the S&P 500 and the Dow. Of course, Nike has been a little bit controversial today after signing Colin Kaepernick with their Just Do It campaign. But in addition to that, we saw the flip side. We saw Amazon hit a $1 trillion market cap, becoming only the second company to perform that feat after Apple just did it last month. So we did have a few positive winners mixed in there as well. And despite today's pullback, we did see that the markets continue to have a bullish posture from an intermediate term perspective using that market forecast indicator. So in today's trade application example, I did want to focus on a sector that did the best here today and a stock that was not able to keep up with that sector, but does have some interesting dividend characteristics. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 4th, 2018. For those of you that are new, first of all, welcome aboard. We're grateful to have you in our audience here tonight. Remember, you can go over to YouTube and click subscribe, and that way you can tune in to David and I's presentations here for the Market Outlook on a regular basis. While you're over there, check out the description area. That'll allow you to sign up for our email distribution list, so that way you don't miss a beat whenever we post these various videos. And you also get access to the various stocks that are giving you overbought and oversold cluster signals within the S&P 500. In addition to YouTube, we're also heavy users of Twitter. My handle is @BrandonVanZee, all one word. I would encourage you to follow me there. And remember, if you get value out of these daily videos, make sure you click like and retweet on Twitter to let David and I know that you appreciate them and you want us to continue to do them for you. In addition to Twitter, we're also on Facebook. You can see the group web address embedded in the logo in front of you, so feel free to join us over there as well. All right, let's go ahead and dive into the market analysis here for the day. As you can see, I've got chart 4B pulled up in front of us. For those of you that are premium Market Scholars subscribers, feel free to follow along with this presentation by looking at that pink label in the upper left of all the charts that we offer you here. Now, as we look at this particular chart setup, first of all, it's a 4-grid that looks at the four major U.S. equity indices. We've got the S&P 500 in the upper left, Dow Jones in the upper right, NASDAQ Composite in the lower left, and the Russell 2000 in the lower right. The other thing that you're going to want to know is that the background color of the chart changes from various degrees of pink and green depending upon whether we have a bullish or a bearish posture using the intermediate term line on the market forecast technical indicator that you can find on the Thinkorswim platform and at other areas over at TD Ameritrade. Now keep in mind that the Russell 2000, as I mentioned in the intro, did pull back fairly significantly today, down 0.42%. But just as importantly for some of you that are candlestick aficionados, you'll notice that this particular candlestick does not give us the warm and fuzzy feelings. Now keep in mind that a hanging man candlestick pattern looks very close to a hammer candlestick pattern. The difference between the two is where they are on the chart. When you're looking at a hanging man candlestick formation, it usually appears at a resistance area or a ceiling. If you're looking at a hammer candlestick pattern, it's usually at a floor or a support. So most folks that would look at this chart would probably say, yes, this looks closer to resistance than it does to support. But a lot of times you do need that confirmation in the days to come that this is really a chart that's going to roll over. So just because we have the candle here doesn't necessarily guarantee any downside action, just something to keep our eyes on and be alerted towards. Keep in mind that the intermediate posture continues to be bullish, and that's why the background color of the chart right now is green, as it is in all four of our charts right here. So yes, we had a little bit of a pullback today, but for intermediate term trend traders, this is still a bullish market environment to be looking for trade setups to the long side of the market. The other thing I would mention is that the color of the moving average itself, when it's colored green like it is in all four of our cases here, it does represent the fact that we have price above a rising moving average, and that's generally viewed as a strong sign for bulls as well. Kind of the mantra of don't fight the tape. Right now the tape is showing us that we have upside action. All right, let's take a peek here now at our next chart setup, and this will be chart 4C. And it's going to be the same for indices here, but in this case, we're looking at what we call our 3 green arrows chart setup, which some of you might be aware is referring to 3 different technical indicators. In particular, we're talking about the 30-day moving average up at the top, then the MACD kind of in the middle, and then the stochastics as the bottom and third individual technical indicator. So what we're looking for are green arrows, and ideally 3 out of 3 green arrows. So as you can see with the S&P 500, the background color is still green, telling us that we continue to have 3 green arrows. We have for quite some time, and the reason for that is we got a green arrow on the moving average back here. We got a green arrow on the MACD right here, and then a green arrow on a phantom stochastics right back here in August. So that didn't necessarily change. In fact, the one change that we did see here today was in the form of the Dow Jones Industrial Average. Notice that we did get a red arrow creep in there into the MACD. So keep your eyes on that. That is signifying a little bit of a loss of momentum. And remember, with a stock like Nike, it's one of only 30 stocks in the Dow Jones Industrial Average. And so when it is down significantly, like it was here today, then that can have an outsized effect on a 30 stock index like the Dow. Let's take a peek now to longer term view. And so for that, we will go over here to chart 4D. And this is our 1040 crossover method. And what we're looking at here are crossing overs of the moving averages themselves. The orange line on this chart is a 10-period exponential moving average. The blue line is a 40-period exponential moving average. Now these charts are 3 years in length, and each one of the candles represents 1 week in time. So that's why this is a longer term view than anything else that we've looked at so far in this presentation. So from this perspective, you can see the background colors of all 4 of our charts continue to be green, telling us that from a longer term perspective, we still have more bullishness than bearishness. And of course, the nice thing about this 1040 crossover method is it would have gotten you into these 4 different indexes here in the United States over 2 years ago to the long side of the market. And of course, you wouldn't have been pushed out, assuming that you were following the rules of this setup, meaning that you're looking for the crossover of the moving average before you take action. And so since none of these have had a negative crossover, you've just been enjoying the bullish gains of your portfolio for 2 years plus at this point using this posture development tool for the long term. Let's now take a peek here at our next chart setup. This will be our intermarket analysis 12 grid. And for this, remember the background color is going to turn green if we have a bullish posture using the market forecast intermediate term line. It's going to have a pink background when we have a bearish posture using the intermediate term line on the market forecast. So as it stands right now, we had a very small move out of the VIX to the upside, 2%. That's not really a big deal for that particular index. We did have an outsized day for the Treasury yields, though. Notice that Treasury yields did spurt higher here today, 1.72% higher on the TNX, and you can see by the size of that candle right there, that was a pretty good sized day. In fact, let me show you here as I right-click and maximize sell, so that way you can see it a little bit better. That's the candle I'm referring to right there. That's a pretty aggressive candle. Now, obviously, it wasn't as big as this one back here, but it is one of the bigger ones on the board. So that was a pretty aggressive day there for yields themselves. And in turn, of course, when Treasury yields are up, bonds are down. And of course, you can see that down below here with TLT. Now, this is chart 4E for those of you that are following along at home. And so remember that yields and bond prices themselves generally are inversely correlated to one another, so not a big surprise right there. But we'll kind of circle back to one of the sectors that benefits from rising yields here as we get into our trade application example here in just a little bit. But you did notice that preferred stocks, which oftentimes act a lot like bonds, struggled today because of the spiking yields out there. You also saw junk bonds falling here today, kind of behaving more like a bond as opposed to a speculative instrument. Remember, sometimes junk bonds don't always act in unison with government bonds, but today it does look like that's exactly what happened. Notice down below, the US dollar had another strong day. We were up 0.44% on UUP. That's been a nice strong move for the last week on the UUP, and that's been kind of a persistent strength of the dollar for the last year or so. Notice that in turn, when the dollar is strong, oftentimes commodities are weak. And you did find that gold prices were down 0.79% today. Ag commodities were down 0.06% today. And even crude oil was down 0.6% today. But in particular, I would say the one that looks really ugly is gold. You know, you look at gold right here. It's been giving us some oversold cluster signals. That's what those green dots are signifying there. And so we do have occasional reversions to the mean, but clearly the moving average itself has been almost the entire 3-month period red. And remember, it will be red when we have price below a falling moving average, kind of the opposite of what I showed you a moment ago. When it's green, it's price above a rising moving average. When the moving average itself is red, like it is with gold, and it has been for basically the entire chart right here, it just is saying this is a very strong downtrend for gold at this point. And right now, that almost looks like it wants to make yet another leg lower after trying to get up to that moving average and then using it as resistance. It almost looks like it's trying to bounce down now. So for those of you that are looking for bearish trade setups, perhaps there's something in there for you. As we take a peek here now at our next 12 grid setup, let's take a look here at foreign stock markets. Now remember, when the US dollar is strong, as it was today, our assumption would be that most foreign stock markets would struggle, at least in terms of US dollars. And that is exactly what we found today. In fact, as you look at all of these charts, I don't see any of them that were up today. In fact, notice how ugly South Africa has gotten. It was down 7% here today, falling from that falling moving average even further and putting in fresh 3-month lows at this point. And remember, South Africa, more than most nations, is hitched to the price of gold. Remember, some of the biggest gold mines on the planet are in South Africa, so that could be what's affecting part of the move lower. Maybe not all of it. 7% is an awfully big move, but it hasn't helped. Let's put it that way. That gold has been in a significant downtrend. You're also finding that Brazil in the upper left corner down 4.5% today. That's an ugly move, and we are basically knocking on the door. In fact, we might be there. Yeah, we are. We're at 3-month lows on Brazil as well, so not a good sign. Remember, it wasn't too long ago, maybe a week or two ago, we started to think, yeah, well, maybe the US dollar is going to weaken here a little bit, and maybe we can find some life in some of these foreign markets. But just goes to show you that when trends are in place, they're awfully hard to change. And right now, we're starting to see some deterioration in some of these foreign markets here, with Brazil and South Africa hitting fresh 3-month lows as of today. As we take a peek here at our final 12 grid, this will be our U.S. sectors 12 grid. Same thing can be said for the background color. When you see green, it means it's bullish. When you see it's red or pink, it means that it's bearish, using the intermediate term line on the market forecast indicator. Now, the S&P 500 is the chart in the upper left, and as you can see, that's actually been a steady eddy trend. Yeah, we did fall kind of out of our channel to a degree here at the end of June, but for the most part, this has been a very easy 3 months. I shouldn't say that, because investing and trading is rarely easy. But I would say that as I look at this chart, there hasn't been a lot of harrowing moments. It's been more just kind of status quo for these particular areas, including the U.S. sectors here that you can see, with the financials up 0.49% today. That was the group that was up the most today. And remember, that comes right back to what I mentioned before. With spiking yields like we saw in U.S. government bonds here today, that generally supports the financials. Now, somewhat oddly, the second best performing category today was the utilities. But I wouldn't read too much into that, thinking, well, is there some sort of disconnected relationship between interest rates and these various sectors? Utilities were positively benefited by a couple of promising rulings out of the California courts regarding a couple of their big-time players and what their, how they would go forward with their liability with the California fires. So I think it was that storyline that boosted the utilities, and it was able to offset the fact that interest rates were going up. Remember, usually when interest rates are going up, utilities and REITs are going to struggle, and we did see that with the REITs here today. REITs were down 0.89% here today, and so so that was the worst performing sector, with the financials being the best performing sector. That relationship is intact with interest rates higher here today. The other thing I liked about the financials is a nice bounce off of a rising moving average. You know, we're not at 3-month highs at this point, but we had a nice healthy pullback. Some of you might identify that as a bit of a bull flag that's taking place there. And of course, a bounce off of a rising 30-day moving average is generally perceived positively by those that want to be bullish on any particular instrument. So that is the area that I wanted to focus on here for our trade application example for the day. So for that, let me go ahead and pop on over here to, first of all, chart 3A. Now, this is the Market Scholars Dividend Stair Step 1 grid, and it's a 10-year weekly candle chart. So let me go ahead and pull that up here. And then I want to pull up a financial stock, in this case, ticker symbol BEN, and this is Franklin Resources. Now, just the way that the think scripting works, unfortunately, it can't account for any sort of stock split. So anytime you see this stock split kind of in the pink font that you see on the chart here, for those of you that have access to this, remember to zoom in after that. It's just a peculiar way that for some reason Thinkorswim does not go back and adjust the dividends per share after a stock split, even though they do go back and adjust the price per share. So then it kind of messes up the think script. But anyway, as we take a look at this, you can see that this is a stock that has struggled. This is a stock that, you know, over the last, let's call it 3-4 years or so, has been largely in a downtrend. Now, this is a mutual fund company, and so this is Franklin Templeton Investments, for those of you that are familiar with maybe their advertisements, or perhaps you own some of their mutual funds or what have you. But the point is, it's an asset management company. Now, this is not a mutual fund itself. This is the stock that represents Franklin Templeton. And so this would be something that you could tap into if you felt like it was an area of growth, or at least you know, positive cash flows in the future. Now, as we look at this chart, I want to identify a couple of things here. This is what I call my dividend stair-step chart. And the reason for that is you'll see these kind of stair-stepping lines here in various colors. Generally speaking, what we're looking for are stocks that are trading below the orange line. The orange line represents what is that stock's average high yield over the last 10 years. And for this particular stock, Franklin Resources, its average high dividend yield over the last 10 years is about 2.4%. In other words, had you gone back and just bought this stock whenever it was yielding 2.4% in the last decade, you'd have done reasonably well for yourself. On the other hand, if the stock is ever yielding 1.94% or less, then it's not as attractive. Then you might be better off looking for another candidate there. So where we stand right now is a yield of 2.94%, as you can see up here in the black label, which is clearly above the 2.4% average high yield that investors have grown accustomed to for this particular security. Now remember, Franklin Resources is one of the 53 dividend aristocrat companies out there, which is a index owned by Standard & Poor's, which basically looks at companies that are both part of the S&P 500 and have also raised their dividends for at least 25 years in a row or more. So one of the few financial companies on that particular index. Well, as you can see, not only are we down here below this orange dividend stair-step line, but we're also approaching the blue dividend stair-step line. And that blue line is a little bit more of an arbitrary number, but it is one that has worked on occasion in the past, because there are a lot of investors out there that won't invest in a long-term position for milking the dividends unless it's yielding at least 3%. So that blue line here, as long as you don't adjust it manually, remember you can, if you're a premium subscriber, you can go in there behind the scenes and adjust that to whatever yield number you want. But if you don't touch it, the default setting is 3%, as you can see up here in the blue label. So we're very, very close right now to touching a 3% yield. And as you can see, over the last several years, it hasn't even come close to touching that blue line. So this is really the very first time that we would be able to attain this company starting with a 3% yield if it does come down and touch this blue line. Well, we're not quite there yet, so one of the things that you can do is sell a put in order to kind of take on somebody else's risk and saying to yourself, I would be willing to buy this company if it falls to a certain level. That's what you're doing when you're selling a put. Well, one other thing I did want to point out is as of right now, notice that there's a little green dot on this chart. I'm kind of circling it right there, just to the left of where I'm circling with my pencil right there. That green dot signifies that this company has a oversold cluster signal right now. And so for those of you that are looking for a reversion to the mean type of a trade, then perhaps this is getting to a point where the market would view it as oversold from a technical perspective as well. So let's go on over here to the trade tab and let's take a peek at some of the strikes that are available. So for this, we probably have to go out here to the August contracts. Yeah, we only got 17 days left in September. So we have 45 days left in October, which then leads us to a return of risk, or a return on risk, I should say, of at least 1%. That would lead us to the 29.5 strike. And so as you can see right here, the last traded price for this was 45 cents, and the bid is 40, the ask is 50. And so we will try to get filled at that level. And remember, if this stock does fall below that level, let's say 29.50 or less, where we would be attaining that stock since we are now selling the put on it, 29.5 is right here where I'm circling it on the chart. In other words, it's below that blue line, and therefore you would have a starting yield of over 3%. In fact, if you wanted to kind of run the numbers yourself, you could take their current dividend amount, which you can find here on the trade tab, and it's 23 cents. And one other thing I should mention real briefly is that they're probably on the verge of raising their dividend on their next announcement as well. Notice they've had 23 cents now for 4 straight quarters, and their pattern in the past is to raise that dividend on the 5th quarter. So this is kind of a conservative number that I'm going to be calculating right here because this is a company that's likely going to be raising their dividends by the end of the year. But right now it's 23 cents. Times 4 to annualize that number, it's 92 cents. If we were then to get filled at 29.5 strike, and we got filled at, let's say, a 45-cent premium right here, that would basically mean that our break even would be 29.05, because remember, I'm basically subtracting 45 cents from the strike price itself. So that would be our true break even number there. So let me take 92 cents, the annualized dividend amount, divide it by 29.05, and you can see that our yield to start that would be 3.16% if we were to be able to buy that stock at a lower price. Remember, you're only going to likely buy that company at $29.50 or less if it falls below there on expiration day. And so if it does go down there, let's say in the next week, and then bounces higher, then what would happen is you would just simply keep the 45 cents worth of premium, but you would not then be privy to the shares of stock itself. So anyway, for those of you that want some kind of more instruction on selling puts and our thought process behind it, remember I teach a class on Monday nights for selling puts and selling covered calls for those of you that are premium scholars. All right, so with that, let's go ahead and place our trade. I'm just going to come on over here, click on the bid price for the 29.5 put there in October, and I am going to try to get filled at 45 cents right there. And let's go ahead and change that to a good till cancel order as well, just in case we don't get filled first thing tomorrow morning. Confirm and send. And everything looks great there. Let's go ahead and fire that off and see how we do on it. All right, well, I want to thank you for joining me here tonight. Hope you all had a restful Labor Day weekend and you're ready to tackle the markets going into the fall and to the winter months here. Remember that the markets were down today. However, we still have those bullish postures from an intermediate term perspective. So we don't want to quite give up on this market just because of one day. But of course, we've got a lot of things going on here with perhaps Canada coming into the conversation with NAFTA tomorrow, and earnings announcements, and who knows what comes out of the woodwork when it comes to news. But as of right now, from a technical analysis perspective, we continue to have a bullish intermediate term posture. So with that, I want to thank you for checking out this presentation. Remember to click like and retweet on Twitter if you appreciate these videos as well. I want to wish you all the best with your trades and your investments. Goodbye for now.